Hello, Oakbrook here, and we are going to talk about diversified energy. So, this an article that is going to be released in the next couple of days. Usual drill. Get to see it first here on YouTube. Let's just make it a bit bigger, so make it easy for you to see. So yeah, look, it's closed tonight at 12.68, which is about £9.50. It closed in London at about let's have a look, 9.58, I think it was. So yeah, it's down quite a lot, and really a lot of that is just virtue of the fact of the natural gas price having fallen, but because, of course, a lot of diversified is hedged, um, and if you look at the average for the last 3 months, so end of June being about here, look, so that was at what, 344. So average for this quarter is about 325, which is there or thereabouts the hedge price anyway. And if you go back to 12 months ago and look at the comparative back then, the hedged price was 320, and the average price was about 270. So it was a substantially less this time last year. And of course, the summer months is traditionally the lowest priced season because, of course, people are not using natural gas for heating it. They're using it for electricity, or it's being used for electricity. Most people are not sort of using it directly for electricity because they would use a they would use electricity from the grid. But yeah, the power stations are using it, and of course using it for cooking and stuff like that. But anyway, what I talk about in this article is the fact that the weather in the US is very, very mild, so warm autumn. Obviously, not so much in the UK. Also, that Diversified is moving their listing to the US. That will mean that they leave the FTSE 250 index, which they've left before. It's not the first time that that's happened, but they'll remain listed in London, but it'll become a secondary listing. Primary listing will be in the US, and there was some talk on in the Chattersphere about the fact that they will join the small cap index, and if they were to, had a little look at that. I mean, just based upon these four funds, passive tracking funds alone, iShares, Vanguard, Schwab, and SDPR, those alone add up to 115 billion, and 0.15% allocation, which is the smallest allocation out of the 600, would equate to about $165 million of shares, which would equate to about 17% of the share price, which is, fantastic, of course. But it's currently at a market cap of about 975, so just under a billion. That many shares at that much each, or at least that was the price at the close today. Um, which, of course, on one hand is a very, very cheap price. We're essentially, this 947 is back to the sort of prices of where it stood back when it was. I mean, if we go back and have a look at the 5-year chart, we can see, it was these prices back kind of at times of great distress, I guess you could say. It was back at these prices. So let's just go 5 years back at these prices. So here in April, so this was on the Trump tariff nonsense, the Lib Day stuff. It was back here last September, and last September was when you had some really, really low natural gas prices, as you did back here. Obviously, this as well was around the time of the short attack. So the short attack was back here, and it culminated here, where pretty much I responded on the short attack pretty much the same day as they released the report, but it was sort of weeks and months afterwards that various other parties started writing articles to sort of say, well, these shorters haven't got it right. And of course, this bit was where Honourable Pallone was asked and answered as to his questions about leaks and so on, and even just this year, they've further reduced the methane intensity. I was reading about it today actually, where in and I haven't sort of particularly written about this uh, in any of my articles, but somewhere in all this morass of information um, was the fact that I think it was that one there, that oh no, that's production taxes, but if we do intensity, that they've brought down the emissions intensity even further during during the there we go, look, 0. Yeah, it was zero point 0.7 from 0.8, so down by about 12%. So so the point is that this is back to the sort of price levels when you had kind of massive short attacks, you had Honourable Poloni, you had the Democrats in power, you know, you had kind of a lot of things going on that were negative. To see it back at this price when none of these things are happening, there's no problem with emissions. I mean, obviously, we're under a different president and a different legislation now as well. Um, I mean, yes, they've bought Maverick, and they've bought as well the Canvas. So they've made two large acquisitions, which in turn is supported by debt, and they've got debt from Carlyle, and they've got a 2 billion line of credit. They've used about 20% of that. The terms of the deal. I mean, I don't want to sort of repeat what I've covered previously, particularly, but I talk about the terms of the deal here, and kind of if you look at it from a yeah, if you look at it from a sort of net present value point of view, and work through the numbers, you kind of conclude that, well, gosh, this is worth about $8 extra per shareholder. So a share that you can buy for 12.68. They've just done a deal that adds another $8 to the long-term net present value, and the overall NPV is something at around about $70, I would say. It's substantial anyway, and obviously that's a long term. It's this bit here where I talk about the net benefit being 862, and this is sort of even after saying, well, there's extra debt, there's extra there's dilution, so, and again, I think it's a little bit of a storm in a teacup about the dilution, because at the end of the day it was 4.2%, which isn't actually that much. And then it's just part of what they do is, they want to grow the company. And actually, when you look at sort of, when people are saying things like, oh, well, there'll be 17% of shares because we'll be part of the S&P small cap 600. Well, a small, excuse me, a small cap in the US isn't that small. It's about £1 billion, is a small cap. So actually, they are probably about 20% below where they need to be to even get into that index. So while some people have speculated that that's what's going to happen come the end of the year, I don't think so. And I mean, not at the current price. And obviously, if they carry on doing buybacks, well, obviously that reduces the market capitalization as well. So you've got to kind of look at these things and think, well, yeah, no, probably not. Will some of the funds that are in the UK sell off, and because it's becoming primary primary US listed? I don't think so. I mean, no more than they've done so already. I think there's a lot of US funds as well, and hedge funds, and investment funds that own diversified. So I think that ship has sailed. Like, really, that ship has sailed. Anyway, um, I guess the reason for this article and the key points to talk about here is, the fall in price. The main reason for the fall in price appears to be that it's sort of tied into the price of gas, which is an oddity when it's largely hedged. It's a bit weird that should be the case, but yeah, if you look at the temperatures out in the US, everything's very warm. So actually, if you sort of look at the level of gas stocks, they are very, very high. It's no surprise that the price of gas has dropped back to $3 per million British thermal units. But these above average temperatures are going to change. So by the end of October, it's going to turn a lot colder. And that's 2 weeks away. I mean, that's no time at all. And higher prices, the futures market says it's not going to stay at $3. The futures market for December, the futures December 2025, um, that is $3.70. Okay, that's substantial movements upwards that are going to happen, what, in 7 weeks? Um, so to be at this very low price level, I mean, I added more today at 9.47, which is why I've put that price on that article. Um, seems like a crazily good opportunity as far as I'm concerned. It doesn't stop there because the following month it's going to rise above to the $4 mark. Okay, above, and that's the future price, which, as we get closer to January 26th, the futures price obviously will potentially drop and other things, but right now the market is anticipating that we're going to see $4 $4 natural gas in the US. Um, and then sort of further forwards, I mean, this is the bit where you've got to sort of strap yourself into your chair and not fall off it, is that go further ahead. I mean, by the next summer, bearing in mind the summertime, as I just said, is the time that the prices are the lowest. Well, it's barely going to move between January and July. Like, even though that this part of the year is when the rebuild is happening, the rebuild of stocks. Well, it looks like the futures market, is not anticipating, um, lots of surplus gas to rebuild the stocks. And if you go even further forward, so this is another 6 months. I mean, we're well into $4, $4.53. And if you go and look at March and April and so on, it's all substantially much higher than it is today. Now, of course, DEC have got hedges, so it's not to say that they're going to just start seeing, you know, $1.50 per MMBTU of extra profit. It will be, um, probably an extra 30 to 40 cents out of that $1.50, because there's about 70-80% hedges. Yeah, so it's not going to be um, some vast upside because of their hedging policy. But um, at the same time, you've got some, and of course, it's not 100% natural gas either. There's an increasing proportion of oil and natural gas liquids involved, but it's still 70% natural gas, about 70% natural gas. Um, so, so yeah, if you look back on the this article, the Decorator Canvas article, there's an upside when you look at it from a PV10 point of view. There's an upside if you look at it from the just the additional income that this will generate. And you could say exactly the same thing around Maverick. I mean, this is the other thing, right? Compared to a year ago, I mean, when they bring out the year-on-year comparisons, I mean, you're comparing. It came home to me when I was sort of looking at this article, because in this article, the exit rate of production was 190, I think 192, I think it was, in here, and a year earlier it was about 130. So they've massively ramped up the production. I mean, we're not just sort of yes, there's more debt, and yes, there's more shares to some extent, not vastly more shares, but there are some more shares because there was dilution because they used shares to get Maverick, they used shares to get Canvas. Um, but on the other hand, you've also got to consider that the income generation has gone up and gone up by a lot, and the fact that the debt is shared across those new shareholders as well. So those new shares that have been issued, they take a share of the debts essentially. So you can sort of see it here where the revenue in the period up to June 24 was 209. In the period up to 25, it was 435. Vast increase. And you can sort of see here a lot of that is the recovery of the price of gas compared to year on year. Some of it was down to volume, so about a third or a quarter was about volume. The price was the big changer there. And same picture over here with apart from oil, where oil had reduced in price, but the obviously the volume had increased. That had driven that change of performance period to period. So I think, what I would say is these gas future prices tell a very different story to what the market's interpreting as to the drop in the share price. Now, maybe there's another explanation for the drop in the share price. Maybe it's down to um, something else, but really the only thing that I can see has changed is the warm weather, the rebuild of stocks, of stockpiles of natural gas or storage of natural gas, and the price of natural gas that, as I say, has dropped from $4.10 to $3, so it's down by a quarter. But it's not going to be long until it's back up to this level again. So this seems to be a very um, kind of a fairly short-term trade, even if you don't sort of believe in the story of Diversified. And I know there's plenty that sort of say, oh, it's a terrible share and all the rest of it, but it doesn't detract from the simple fact that this price drop is illogical compared to the futures market and compared to the additional synergies and production that's going to be coming on stream. We've already seen evidence to that. Again, I would sort of point you back to the evidence in the 1H25 results that clearly show that they are progressing further forward on the back of the Maverick acquisition, that they are achieving synergies. And we'll see more of those in 3Q 2025. The results are about a month away, about 4 weeks away. And we can see here the additional, I mean, the Canvas deal hasn't closed yet. It's going to close in Q4. So the Q3 results are not going to be anything other than what we're going to be expecting to see is, I mean, a couple of things really. That we're going to want to see improvement in synergy. So we're expecting 60 million of synergy. So do we see evidence to that? Do we see improvements in G&A costs? That's going to be the focus. And obviously, because it's a trading update, we don't always get the full financials, but because they are moving over to the US, and of course the US approach is to do quarterly earnings, we will get full disclosure of financials is the key point there. So a couple of other things to say. The EBITDA income, you can sort of see it here, 1005. I mean, anticipating that to be at around $1 billion. Obviously, the debt being that, and the share price being 975. I mean, you're looking at about an EV/EBITDA of about 4 times. The average of most other things out there is not 4 times EV/EBITDA. I mean, in this presentation deck earlier in the year, they describe it as 4.5 times. I would say that's now lower, in my opinion. So, pretty much everything else out there, and obviously these are sort of sectors rather than individual companies, but you can see like 4 times EV/EBITDA is incredibly cheap. For every dollar, I was about to say pound, but every dollar of either equity or debt, it's generating 25 cents per year. Obviously, the dividend yield is very attractive as well. I mean, that's another reason just to say, do you know what? Actually, getting it at the current price of £9. I mean, you've got a yield of close on to, I think, about close on to 9%, if I'm not mistaken. That the don't know if it'll tell us this here. So if we look at the 9.21, you know, that I mean, I appreciate that's kind of a jump from about 8 or 7.8 to 9.2, but every little helps, and you're locking in a fairly nice yield where, well, I mean, obviously, as I say, you might look at this as a trade, you might look at this as a long-term investment, but it's either way, there's another dividend at the 31st of December. So and then another one at 31st of March next year. And it's whilst people obviously there was a time when they were paying like 3 times more dividend. I mean, you would have been on about a 25% dividend. That they cut that back and focused on growth, which obviously they've achieved a lot of growth since they cut the dividend a few years ago. So a couple of other things to say. I mean, the new energy outlook, I thought this was interesting. So this is the forecast of the movement of natural gas production in the US in 2024. So you can sort of see, there's a good chunk of additions from the Haynesville, um, um, what's the word? The Haynesville area, the Permian, Appalachia area, and then sort of remaining 48, 0.3. So we sort of see a jump from 110 to more or less 115 during this current year. But look at the forward forecast for 2026. I mean, complete change. So Permian drops from 2.3 to 0.3. Appalachia drops 1.3 to 0.8. 0.3 drops to minus 1 billion cubic feet per day. Haynesville halves. I mean, if that's not sort of further evidence of the rollover of shale, I don't know. It's obviously some of that is going to also be um, less exploration, less drilling going on. But the point is that the decline rates for the US are pretty substantial. Um, and contrast that's the supply, and then contrast it with the demand. I mean, the demand for export of natural gas alone. This is 2026, so we're going to see Golden Pass, Corpus Christi, Stage 3, Plaquemine. All three of these are adding about 5 BCF per day. So you've got 5 BCF more demand, and you've got essentially a rollover of supply. Um, that we're looking at what, zero point 0.5 net, yeah, 0.5 versus these forecast volumes for LNG. And of course, these numbers here are US, don't include the Canadian. So Canadian kind of doesn't really have any bearing on the central region, but it does have a bearing on Appalachia, where the Canadian gas can also supply into New York and that sort of northeast, New England kind of area. So there is a bit of um, relevance there that the Canadians are going full on to be exporting their gas as well, and not just sending it to the US market or using it domestically, which is what they've historically had to do. And that's why the Canadian natural gas has been something ridiculous like $7 a barrel of oil equivalent. I mean, it is literally well, not literally, but it's very, very close to just being suicidal pricing, because you're not making any money at those prices. You're just sort of selling it to get rid of it rather than selling it as a commercial venture. So this the LNG demand is before we even consider domestic demand in 2026. Now, there are no 2026 forecast numbers here, but we obviously can see natural gas consumption through electrical power, particularly, and obviously this is AI and data centers and electrification of the economy. Now, there is some evidence that this will slow down during 2026 because renewables are going to take a lot of the strain and a lot of the expansion, and there's some talk of um, nuclear and small modular reactors, but small modular reactors are years away. I mean, they're not going to happen in 2026. So we might see some expansion of coal in the US, we might see some expansion of natural gas. And yes, there will be renewables, but I think there'll still be a need for expansion of natural gas in the US. So and then heating, residential, commercial. I mean, heat pumps are not making any kind of headway in the US. Industrial, again, that's a pretty static demand, and other is some of that other, by the way, is exports to Mexico and other things like that. So again, you can see that's a growing trend. So will we see a rise here of, I mean, you can sort of see between what that year and that year in 5 years, it's about 10 BCF, so it's about 2 BCF per year on average. But of course, this electrical power is accelerating because of AI. So we could see 2, 3 BCF in 2026 of additional demand, maybe more, maybe 3 to 4. So when you take all of that together, 3 to 4 there, probably about 4, 5, 6 BCF or 4 or 5 BCF here. So you're looking at nearly 10 BCF extra demand versus zero point 0.5 extra supply. So, like, is it any surprise that these future markets are saying, I'm prepared to pay 453 for gas in February 2027 because I'm looking at these numbers, like the futures market are exactly looking at these numbers and these numbers and these numbers and kind of working out that 453 is incredibly good value. Okay. This is another report. So this is the OPEC report. OPEC back in July said production, and I think this is million barrels of oil per day. So it's uh, OPEC plus. So this is sort of the whole of OPEC. Um, started July, so end of June, it was 42.97. They ended at 42.72, so it dropped. End of August, it was up to 43.01. It ended September at 43.99. But this number here is the spare capacity. So what we see is spare capacity, and I went back as well. Spare capacity is dropping, dropping, dropping. One of the things I was particularly interested in is, well, how much spare capacity does OPEC have? Because reputedly, they have lots of spare capacity. Well, 3.4 million barrels of oil. When world demand for oil is going up by about 2% a year and has been going up 2% a year for the last 5, 6 years, maybe 5 years, because obviously COVID was not a 2% year. But since COVID, 2020 to 2025, 2% a year. So 2% a year is about 2 million barrels per year. So what you're looking at there, if that 3.4 is a real number, which it of course may or may not be, because just because they say they've got spare capacity doesn't follow that they actually do. But during 2026, that spare capacity could be gone, could be gone. So it's not just natural gas where I'm seeing brighter times ahead, but oil as well. I mean, maybe with oil, it won't be 2026 specifically, it'll be 2027. But I think a time is coming. The thing that just I keep coming back to in my mind, and if I just maybe can just show you a chart where I just draw three different things. Um, so here we've got let's do the 5-year chart for diversified. So you can sort of see here, this is when they cut the dividends and whoosh, down it went. And here they did the short attack and whoosh, down it went. So you can sort of see, it's trading at about a third of where it stood in years gone by, even though when you actually look at the profits that it's generating today and the position it's in today is far stronger than when it was back here. It's just that it was paying out very, very generous dividends, and I suppose that kept the music going. Anyway, the two things I wanted to add into this, if I can, would be to add in gold. Um, let's add in gold and to add in oil, which should be, let's maybe do an oil ETF if we can. So there's oil services, yeah, maybe BRNG. So I haven't sort of practiced looking at these, but yeah. So what we see, obviously, the scale looks a bit weird here. Um, yeah, I'm not sure that gold is accurate. Yes, because we've got gold mining incorporated. So let's try getting a gold ETF instead. Physical gold, Gilder. There we go. That's better. So, but even that looks a bit weird. So what have we got here? So I think that has to go, and that certainly has to go. And oil barrel. I don't know whether we can get oil. Just trying to think how we get, or maybe I can't. But what I was hopefully going to show you there was the comparison to well, I could do it here actually. Thinking about it, let's do it here. So if we take crude oil, US crude oil, and I just add in gold there, and we just sort of say, let's say over 10 years, there we go. So comparatively, I mean, you can see, the amount. So here, the amount that you can get, so 4,100 versus 60. So, I mean, you're into the realms of about what, 70? Let's do the maths quickly. So 4133 divide by 60, 68, 69 barrels of oil per ounce of gold. Now, that ratio of 69 barrels of oil, it's just unheard of. I mean, I don't think there is a time in the past ever that you could buy 69 barrels of oil with 1 ounce of gold. Just hasn't happened. Hasn't happened. So we are in unprecedented times, and I do remain of the view that oil is going to go up in price to mirror the fact that it's below its cost price, or it's below its replacement cost price. And that's perhaps the final thing that I'm going to talk about here, is that actually when you look at natural gas and oil expenditure, to keep the level of production where it is, you need to be spending at least 600 billion US dollars per year. And you can see the amount of exploration that has been going on over the past 10 years has been dropping. I mean, it's not an entirely clear number, but you can see that that is dropping. Conventional fields investment has declined versus history, and the reason for that is that there's been, of course, the growth in the tight oil, tight shale, and so investment, generally you could say is lower now, and certainly has been below replacement for a number of years. And the estimate here is perhaps a little bit on the high side. Um, to maintain, so this is from the World Energy Investment Report, that from the IEA. And so basically, at the current level, we are below the replacement level. So this is below the amounts that have been discovered. So in order in order for production to remain where it is, we need to be discovering 1 trillion cubic feet of gas every year, and 10 billion barrels of oil every year, in order to have any hope of maintaining production. In other words, we are well below the investment level to maintain production of oil. So we are going to see a reduction of supply of oil because there's not enough investment, there's not enough exploration, there's not enough. You can sort of see here new exploration that would not bring production online until the 2040s to maintain oil and gas production at today's levels through to 2050. An additional 19 million barrels of oil per day and 660 billion cubic feet would need to be produced from fields not yet discovered. This would mean that on average we have to discover 10 billion and 1 trillion each year in order to make that happen, and it's not happening. So we are sort of heading towards a car crash of demand and supply is what I'm saying. That the IEA speak about. So if investment into oil and gas stopped tomorrow, which would please some politicians, but if that were to happen, um, and I suppose in the USA is the stat that I've got here, the current level of production of about 1.1 trillion cubic feet uh, would drop, and would drop very dramatically over 10 years back down to about zero point 0.3. So it would drop by about three quarters. Okay. The green is based upon the current approvals, existing and approved fields, based upon their development. That's how much by 2035 will. So in other words, this green line is arresting the decline. The red line is the decline over 10 years. So we're kind of, no matter what happens, we're going to see a 10% cut in supply, no matter what happens, just simply because it's not possible to A, discover, and B, permit in time to have any effect on these numbers up to 2025. Now, there is, of course, the net zero 2050 targets and all of that good stuff. If that's going to happen worldwide, and I say worldwide because it's not just about Britain sticking to its rules or self-imposed rules, and even just the US sticking to its rules, which it doesn't have. It doesn't have any rules, but it would also mean China, India, all the other countries in the world also um, adhering to the rules where they themselves have said they're not going to be compliant with 2050. I think it's India is 2070, net zero 2070. China, I think, is 2060. So even they are not compliant. But if somehow they were, and if everybody else were, then what we're seeing here is this red and green become light blue and dark blue. So apologies, they go and change the colors for no good reason, but it's still the same report. So basically, the green is where the demand would reduce in a net zero world. So by 2050, um, with no further investment, we would have the light blue lines, okay, which you can sort of see relative to today. And I say today, I mean it's obviously this is last year, but last year and last year, demand and supply were roughly equal to one another. Okay, what we see here is that with no further investment in the next 10 years, this blue line here is basically this 300 here. So what we're saying, like you can sort of see it here, it's, well, I mean, technically it says 440 MB per day. I think that's a per day, and that is a per year, because that's billion cubic meters. And I think because it's meters, not feet. So again, I think they've gone all screwy with all the scales and everything else. But the point is that we would have more supply than the demand if all of the investment, all of this green line continues. We would have more than enough supply. If demand gets cut by about 50% in the next 10 years. Now, not being funny, but you've got to take pretty much what half the vehicles off the road, half the airlines out of the skies. You've got to stop like the developing world developing, like India, stop burning coal, stop selling cars. In other words, how's this going to happen? Like how? It's not. This green dot is going to be somewhere higher. I mean, in fact, at the moment with the trajectory of things, I mean, this green dot is going to be up here somewhere. We're moving from 100 uh, million barrels per day up to sort of 110, 120. And I think I've written about this in a past article. I haven't dug it out ready for this commentary, but you know, we're not heading downwards any at all. Demand for oil is heading upwards as far as I can see. I mean, maybe it'll head downwards a bit, but it's not going to be anywhere at this level. I don't think, not at the moment, not what I'm seeing in the world, and therefore you're going to have something like what, a 30 million barrels per day deficit of oil in the next 10 years. Now, will it take 10 years? I don't think so. I think this is happening a lot sooner. And here's the evidence. I mean, it's all there in that International Energy Agency report that this whole net zero thing, and it's the same over here with natural gas, obviously not quite as extreme, but again, we are going to halve the amount of natural gas that we burn in the next 10 years. Are we? How who's gonna switch off half the gas power stations? Now, I mean, yes, there'll be more solar and intermittent renewables generating more power. But again, look at the demand increases, like the supply increases. I mean, we've just said the supply increases are dropping. The supply increases are not increasing, they are dropping. The North Sea, it's all closing down. Half of Aberdeen has left Aberdeen. When I say half of Aberdeen, the oil and gas presence in Aberdeen have left Aberdeen. Hunting, I've written about hunting. Uh, you know, BP announced that they're going to sell a load of stuff off to Serica. So they're leaving the North Sea. Like, where's this halving of gas demand going to come from? Now, halving of gas supply, yes, I could potentially see that might happen in the sense of certain areas of the world, in the North Sea, because of politics. But it's not decreasing in Norway, the Middle East, excuse me, the US to some extent, South America, uh, and other places of the world. That gas is to some extent. But the point is that the gas in the US, um, I think with shale and unconventional, we aren't going to see dramatic increases. They'll be pushing on the accelerator pedal, and the accelerator pedal will stop working as well because they've taken all the tier one stuff. The Permian, they've drilled out the best of the Permian. They've drilled out the best of the other fields. The Haynesville and the Appalachia and so on. That they're left with sort of tier two acreage that's not quite as good and is not going to be quite as productive. So again, you've got this. I mean, where's this investment going to come from? Like, who is investing into? I mean, DEC is investing into buying production, but how many companies are expanding their production? I mean, it's not not that many. It's more of a consolidation than anything else. So, and I've read other sources, Wood Mackenzie, the EIA, the OPEC report. So this whole thing about there being a glut of oil. I mean, yes, there is today, and a glut of gas to some extent. It's warm weather in the US, but these are very short-term factors, and whether it will be specifically in 2026, I couldn't tell you, but we seem to be on that cusp. And certainly when you look not too distant future, there's some really, really strong macros that mean you know the the fact that that an ounce of gold buys 69 barrels of oil. I just that statistic just eats away, bothers me. Anyway, Final thing to say is we're a month away from the 3Q results. Um, the average price is, looking at about $19.50 barrel of oil for natural gas. And obviously, when you factor in more oil, NGLs, you're looking at a basket price probably at around at least 25. Obviously, you've got the hedging as well, but at least 25, if not more, and that's going to be a lot more than what we've seen in past, certainly comparatively. We look back on the 3Q24 results, the 3Q25 results are going to be substantially better in my opinion. We've also got the continued improvements. Obviously summer is usually a low, that's the time that the prices are low because people aren't using gas for heating, are they? It's warm, the summer is warm. So they're using electricity and air conditioning in the US, but not so much the heating, which comes into play in the winter, same as in Britain. So, normally you'd see a rebuild during the summer months, and there has been a rebuild. I'm not saying that there hasn't, although at times, it dropped down to the minimum of 5 years, so it wasn't all plain sailing. There was some, times when demand and supply were not as loose as they had been in certainly far tighter than they'd been the year before. And if you had an even tighter year next year, no wonder the future prices are going to be what they are, what I've shown you there. So the mild September, the hot August, all of these things will feature into the 3Q results. But I think what we'll see is last year the average production was 138. As at the end, the exit rate, it was 192. So again, you're looking at sort of what, a third more production comparatively. We've also got the Maverick synergies that we're going to see. So we've already seen some synergies. We saw a sort of $0.25 of savings in 1H25. So what they say is that we're going to see in the third quarter the technology and administrative integrations are completed. We're going to see further land sales. We're going to see synergies of production, and this little funny diagram is kind of where we're taking bits of Maverick, bits of DEC, and you zombieing them together, Frankensteining them together into one single circuit and one single um, sort of reduction in headcount with one well manager instead of two, that kind of thing. So we're going to see lots of, hopefully lots of meaningful synergies. We're expecting 60 million, so we'll see what that looks like. You've also got the IRR of 60% of the actual drill out of the joint venture and the production. I mean, they managed to get about 1,000 a day back in the 1H25 results, 60% IRR. So will we see another 1,000 in 3Q25? I mean, in order to do what they describe as meaningfully offset the 10% decline, well, the answer is, well, you've got to see about 1,000 because the 10% on 192, 10% 192 is 19. So to meaningfully offset that, I mean, what's meaningful? Would be at least half. So that would equate to 10. Okay. They've managed to do one. If they do another one, that's two. Offsetting on 19, that's 17. Well, that's not meaningful. In 6 months to have offset what, 10% of the 10%. So you've taken the decline from 10 to 9. Is that meaningful? Probably not. It therefore will have to be, or should be, a higher number than 1,000 barrels a day. I mean, obviously they were just getting started. The Maverick deal closed late March, so the 1H25 results probably didn't properly reflect the synergies and the drilling work that was being done there. And there's a 29% working interest. Essentially, I think DEC are sort of, they're getting the upside of the production, but paying a proportion of the drill out costs. But obviously, it's not their style to do that. So it's a little bit, I suppose, the 60% keeps it You know, it kind of makes sense, I suppose, at the end of the day. So we'll see. You know, like the reduction in meaningful declines is something else to be looking out for. We'll also, I think, based upon the 3Q25 results, be able to see whether I'm at or close to my estimate here of, you know, that we've got sort of extraordinary costs, but then you've got synergies, and then you've got sort of depreciation, you've got the EBITDA earnings, which were, you know, 950 or 925 to 950. So, you know, we'll get an idea as to whether we are at or close to. I mean, but if we're anywhere close to this number here, um, pat of profit after tax of $245 million, um, which translates, because obviously the FX rates dropped quite a bit, or a little bit anyway, down to about 134, 133. So that's kind of, you know, sort of equal to about 190 million, I would say, today. But that 245, I mean, going back to the market cap, which is 975, I mean, not only is it 4 times enterprise value to EBITDA, it's also 4 times price earnings, because that, um, you know, that will be sort of, you know, a quarter of the market cap, which is 975. So, like, don't tell me that 4 times price earnings for a major oil producer is about fair, because I would point you towards something like iShares PXE or Invesco XLES. Now, these are oil producers. I mean, this is the likes of Conoco, Exxon, you know, what are they called? Sorry, the name's gone out of my head. EQT. Sorry, I was forgot their initials. EQT, which is a big competitor to DEC. Now you might say, oh, well, they're the big boys, they're the majors. Well, Diversified's now the fifth largest. So I mean, you know, yes, Exxon, Chevron, Conoco, you know, they're all sort of in that same ballpark. But I mean, Diversified's now a billion, you know, billion profit. So it's not that unfair a comparison to say, well, hey, hang on a minute, all these other companies are at 14 times price earnings. How come Diversified is 3.5 times cheaper at 4 times earnings? If we get to that 245 number or somewhere close, you know, it might not be precisely that. And obviously, there'll also be all the unsettled hedges and all of the noise to consider as well. So it'll be a case of stripping those out to sort of have a look at it. And that's it. That's my thinking on this. And just to call out, you know, that the fact that this has dropped as much as it is, as far as I'm concerned, it looks to me like a great opportunity to pick up more DEC, or to pick up DEC if you don't. But ultimately, that's not investment advice. That's purely me um, thinking through my own thinking. You make your own investment decisions. And thank you for watching this video on diversified energy. My Substack is here at theoakbloke.substack.com. So this article will be released there in the next couple of days. Usual drill. Thank you for watching, and cheerio from me. Cheerio for now. Cheerio.